Every month, the average professional earning $80,000 or more burns through about $200 in fees they never agreed to and can't see on a single statement. Over a 30-year career, that's not a rounding error. That's a six-figure number compounded against your retirement. And the worst part? Most of it can be eliminated in a single 90-minute sitting on a Saturday morning. There's a category of money loss that almost nobody talks about because it's not glamorous. It's not crypto crashes or stock market crashes or housing bubbles. It's the slow, steady drip of recurring fees, hidden charges, and quiet markups that show up every month on professionals who are otherwise pretty good with their money. Here's the problem with this kind of loss. It doesn't feel like loss. A $9 maintenance fee on a checking account doesn't register the way a $900 repair bill does. A 0.65% expense ratio on a retirement fund doesn't feel like the $4,000 a year it actually costs someone with a $500,000 401k. But every single one of these fees compounds against the same money that's supposed to be compounding for the viewer. So here are the 7 categories where the leak happens, ranked by how much they cost and how fast they can be killed. Number 1. Bank maintenance fees and overdraft fees. The average American household with a checking account at a major brick-and-mortar bank pays somewhere between $6 and $16 a month in maintenance fees alone, depending on the account type. Add in the occasional overdraft, the wire transfer fee, the paper statement fee, and that number can climb past 40. Here's the absurd part. There are dozens of online banks, Ally, SoFi, Capital One 360, Charles Schwab, that charge 0 monthly fees, refund ATM charges anywhere in the world, and pay actual interest on the balance sitting in checking. So this fee category isn't just costing money on the front end. It's costing the interest that the same balance would have earned at a bank that actually pays for the privilege of holding the money. Number 2, the bank arbitrage problem. This one is bigger than most people realize. The standard savings account at most major US banks pays somewhere between 0.04% and 0.40% interest, and the FDIC's blended national average across all savings accounts in the country is just 0.38%. The same bank turns around and lends that exact money out as auto loans at 7.99%. Mortgages at 7.5%, and credit card debt at 24%. A high-yield savings account at one of the same banks just mentioned is currently paying somewhere between 4 and 4.5%. On a $30,000 emergency fund, that's the difference between earning $12 a year and earning $1,300. Number 3. Credit card foreign transaction fees and currency conversion markups. This one is a little more niche, but for anyone earning $80,000 or more, the odds of traveling internationally, paying for an overseas SaaS subscription, or buying from a foreign vendor are extremely high. Most credit cards charge between 1 and 3% on every foreign transaction. On top of that, the card network, Visa, MasterCard, adds an FX conversion spread that the cardholder never sees on the statement. The combined cost on a $5,000 overseas trip is usually somewhere between $100 and $200 in pure fee, and every major travel rewards card on the market, the Chase Sapphire, the Capital One Venture, even cards with no annual fee, has eliminated the foreign transaction fee entirely. Now here's where this story turns, because the first 3 categories, bank fees, idle cash, FX fees, are actually the easy ones. They're visible-ish. Anyone willing to look hard at a statement can find them. The next 4 categories are different. They don't show up as line items. They show up as a smaller number than they should be. And the reason they're so dangerous is that the brain doesn't register a missing $4,000 the same way it registers a $40 bank fee. There's no notification, there's no alert, there's just a slightly emptier account at the end of the year. This is where most of the money is hiding. Number 4, brokerage cash drag. When dividends pay out, when a sale settles, when a contribution lands in a brokerage account, that money sits in cash by default. At most major brokerages, that idle cash earns somewhere from near 0 to under 0.5%, even when treasury bills and money market funds at the same brokerage are paying over 4%. For a viewer with $50,000 in a brokerage, that includes a few thousand in idle cash at any given time. The difference between auto-sweeping into a money market fund and leaving it in default cash is roughly $1,000 to $2,000 a year. The fix is 2 clicks, move the cash into VMFXX or SPXX or the money market fund the brokerage offers, and it's done forever. Number 5, expense ratio creep. This is the big one. The expense ratio is the percentage of fund charges every year just to exist, paid out of the fund's returns, never as a visible line item. An S&P 500 index fund from Vanguard or Fidelity charges 0.03%. Some actively managed mutual funds, and this is the part that's often a surprise, charge over 1%. On a $500,000 retirement account, the difference between a 0.03% fund and a 0.65% fund is over $30,000 per decade. Almost every 401k plan offers low-cost index options. Almost every IRA does too. The problem is that most professionals set their allocation one time, back when they first opened the account, and never looked at the expense ratios again. Meanwhile, a chunk of their retirement is quietly hemorrhaging into management fees. Number 6. The phantom subscriptions. This one's been covered to death, so here's the version that actually matters at the $80,000 plus income level. It's not about the $8 streaming service. It's about the SaaS subscriptions, the gym memberships, the cloud storage upgrades, the premium app tiers, and the auto-renewing software that someone signed up for during a trial 3 years ago and never canceled. A spot check at this income level usually finds somewhere between 2 and 6 recurring charges that the person doesn't recognize, doesn't use, or genuinely forgot existed. Number 7. The tax inefficiency tax. This one is the biggest and the hardest to see. Tax inefficiency is the fee paid for holding the wrong investments in the wrong accounts. Bonds in a taxable account when they could have been in an IRA. High dividend stocks in a taxable account when they belong in a 401k. Realized short-term capital gains when long-term holds were possible. Mutual funds with high turnover instead of ETFs. The IRS doesn't send a bill that says tax inefficiency fee $800. It just collects more than it would have every April forever. For someone with a multi-account portfolio over $100,000, optimizing what's called asset location, putting the right kind of investment in the right kind of account, recovers somewhere between $500 and $5,000 a year, depending on income bracket. Add up the 7 categories, and the math on a typical $80,000 plus earner with a few accounts and a normal financial life looks something like this. Bank fees, $144 a year. Idle cash drag at the bank, $1,300 a year. FX fees, $80 a year. Varies. Brokerage cash drag, $400 a year. Expense ratio creep, $1,500 a year. On a $250,000 retirement. Phantom subscriptions, $600 a year. Tax inefficiency, $1,000 a year. Total, roughly $2,400 a year. $200 a month. But the real number isn't $2,400. It's what $2,400 a year compounds to over 30 years, invested at a normal market return. That's somewhere between $200,000 and $250,000. From fees alone, from things that didn't have to be paid. The promise at the start of this video was that 90 minutes on a Saturday morning could kill most of these. Here's what those 90 minutes actually look like. 30 minutes, open the last 3 months of every bank, brokerage, and credit card statement. Highlight every fee, every recurring charge, every interest payment under 1% on a balance over $1,000. 30 minutes, open one new high-yield savings account. Move the emergency fund. Switch the brokerage cash sweep to a money market fund, and cancel any subscription that doesn't pass the "Would I sign up for this today?" test. 30 minutes, pull up the expense ratios on every fund in every retirement account. Anything over 0.20% gets evaluated. Anything over 0.50% gets replaced with a comparable index fund inside the same plan. 90 minutes, once a year. The compounding math from then forward runs in the right direction. If you want to see more of this, please like and subscribe. The most expensive number in personal finance is the one nobody's tracking.